Josh, I want to thank you again for taking the time to do this and share your experience, both to attorneys in the business as well as homeowners. We've done a couple very detailed videos on specific type of denials. In today's age of trying to get a lot done in a little time, I was hoping we could just go over some of the most common denials that we see on a regular basis.
Sure thing. Good to see you again, Bobby.
Absolutely. All right. So again, I created a little graph here. Some of the more common reasons for denials that we see on a regular basis. I don't know. Start wherever you'd like. Go clockwise or counterclockwise, however you'd like to go here.
All right. So, failed to execute the loan modification properly. I mean, that's one that makes people go a little crazy. They feel like they're being gaslit. I did what I was supposed to do. I did exactly what they told me to do. They tell me I didn't sign or return the loan modification properly. That's usually not the case. So if you're in a situation or your client is in a situation where they've complied with instructions and the loan modification is either delayed or rejected, the bank is usually wrong. We've got a number of cases on this category where the ex-wife or ex-husband, the ex-spouse is on the modification, even though the application was in only your client or the bar or the remaining borrower's name. They can't do that. That's a violation of the rules, and mortgage services do it all the time. You do an application in your name, you get a trial plan in your name, everything's fine, you make the payments, the modification comes in your name and your ex's name. You can't necessarily get the ex to sign. This house doesn't belong to them anymore. You've split it in a divorce. They're not asking them to sign a document that says they're responsible for the payment again is crazy. And the banks are not allowed to do it. And so that leads to a notice of error and a big fight. And we've won a number of cases in those. Payment going up. Look, these rules, most of them came into place during the half a generation of the US when there's basically free money, really low interest rates. And then we got to a huge bump in market value with COVID, which led to inflation, which is only accelerating. And so now anytime somebody wants to modify a loan that was taken out in 2010 to 2015, their interest rate's 4% or less, the new interest rate's going to be 7%. So the lender's position is, well, wait a second. If a borrower defaulted at 4%, why would I give them a modification at 7%? And the answer is because every modification is going to be at 7%, and because there are many reasons why people fall behind on loans, and many people can afford the 7%. And so if you get a denial because your interest rate went up, either one, there is likely an exception in the guidelines you have to ask for, or two, more likely, they're just wrong, that the payment going up is not actually a part of the guidelines. If they insist it is, then you send a request for information and notice of error, and they make you show you in the guidelines that they are obligated to deny everything in which a payment goes up. And we also get one, an investor does not do modifications. So that's usually not true. There's a number of FHA loans and Fannie Freddie loans where the new owner says, oh, we don't do modifications. That's a lie. It's an absolute lie. They do modifications. They tell you they don't, but they do. And the same thing you do. If you get someone that says the payment went up, I can't give you the mod, those are the guidelines. It's the same process as when an investor says, we don't do modifications. All right, time to put up or shut up. I want to see the guidelines. Here's a request for information. The only thing I want to see is the portion of your guidelines internal that says the investor does not do modifications. They're not going to want to give it to you. Strategically, speaking to the attorneys out there, they're not going to want to give you anything about their guidelines. And that gives you an opportunity to force a settlement. But if you have to push it, you push it. You say to them, look, You can tell me you don't do modifications, but I sent you an appeal. I sent you a request for information. I sent you a notice of error. When you didn't give me the responses that I'm entitled to, I sent another notice of error, 3 or 4 notice of error in, and your client still doesn't know that the investor doesn't do modifications, and you file a RESPA suit and you force a settlement or make them give you their guidelines, which they don't want to do. And this all goes back really to the fact that there is strength in for the consumer where an investor, all of them, doesn't want to give up any information about guidelines. So when you can make the guidelines relevant, you've got some power that you didn't have before. All right, unable to reduce payment. So that's similar to the payment going up. And this one is a little bit trickier because there are guidelines that don't allow the modification when the payment is unable to be reduced, but you have to make sure that they're extending the loan 40 years. And you have to make sure that your borrower doesn't have the ability to put some money up to reduce the principal so that a 40-year term instead of a 30-year term on a remaining principal meets the guidelines. And also, just like everything else, if they're going to tell you they have a guideline that says they can't modify unless they can reduce the payment, show it to me. Okay? All good lawyers are from the show me state. Show me. Show me the guideline. Show me the guideline. Here's a request for information. Give me the guideline. Here's a notice of error. I don't believe you that your modification guidelines include an unable to reduce payment. Oh, you're going to send me an explanation that the information that we're looking for is not available to us because it's privileged? It's not privileged. Send me a confidentiality order. I'll sign it. Now send me the guideline. Oh, you're not going to do that? Here's another notice of error. And here's another request for information that indicates that has a document in your intake that says that this information is confidential. So I hope what attorneys especially are taking from this, and I'm going to keep going around this wheel, but I hope that what attorneys especially are taking from this, and consumers, but this really more is for attorneys, is when somebody takes a position, when a mortgage servicer and investor takes a hardline position, no. You have power under RESPA to make them explain no. They don't want to. And even if their no is right, but it usually isn't, sometimes it is, even when it's right, for them to prove that their no is right, they have to go places and do things they don't want to do, which gives you leverage. So push back on any explanation of a denial. Payment not affordable. Again, what are the guidelines on affordable payments? This one is even easier in a way. Let's say you get a denial that says we can't modify your client's loan because your payment, the new payment, is not affordable per the guidelines. Well, that right there is a violation of RESPA because the explanation doesn't tell you enough information to do an appeal. You need to know, and this is an appeal or a request for information or a notice of error or all three. You need to know what the guidelines say the income needs to be, what income they relied on, what income they concluded your client or you were submitting, and how far off it is from what's required to meet the guidelines. Because if they tell you the payment is not affordable and then they explain to you what the guidelines are, which is never going to happen. Let's say we're living in fantasy land with fantasy mortgage servicer and fantasy investor. Fantasy being we're living in a universe for the moment in which servicers and investors do what they're obliged to do under the law. But let's say in fantasy land, the mortgage servicer and investor opens their whole everything, hands you the guidelines and says, look, we saw your client at $8,600. That's what they make. They owe $350,000. The monthly payment doesn't match their income according to our guidelines because you're $700 too high. That would be a 100% acceptable denial. However, because it's acceptable denial, it gives you room to maneuver. You can say to your client, look, in order to get that payment down $700 a month, you need to pay off X dollars from the mortgage. If we can find a way to do that, then you are eligible And you can submit an appeal and a new loss mitigation application that matches their guidelines. And so everything circles back to, if the guidelines are relevant to your decision, they're relevant to me. And if they're relevant to me and exercising my federal rights to know why I'm being denied, to do an appeal, and to make sure you're following your own rules, then we need to see those guidelines. Okay, let's go to the next. Did not receive documents. How many times have we heard that, fellow attorneys? Borrowers out there who are watching this, I'm sure you're nodding along. Yep, received that letter 700 times. So what do? First, you send every single piece of information to the mortgage servicer by a request for information. It goes in as a request for information. You submit as a request for information. You follow up with a request for information to confirm that they receive XYZ. If they don't get back to you in 10 days to confirm the receipt, they don't get back to you in time, then you send a notice of error. You need to confirm that you received these documents. And if you are as an attorney and a client comes to you and says, I applied a bunch of times, I sent these documents, they said I sent it back, that's probably, unless your client is highly organized, it's probably too complicated to take on right there and go back in time and nail the servicer for not accepting the documents that they received. In our practice, unless a client has everything lined up and documented, which they almost never do because it's impossible to do by a normal human who doesn't do this for a living and still has to, take Bobby to soccer practice and everything else in life. There just isn't time to really do this organized. What we do is just start from scratch. We say, okay, let's get it in. Submit the application, send it by a request for information, send a request for information to confirm they received the documents. 10 days go by, no acknowledgement, a notice of error. 30 days go by, no response, notice of error. And so you end up in a situation where there is a blizzard of communications, but it's coming from me to them, not from them to me. And because I documented everything and already indicated that they've made mistakes and violated the servicing, when they send a letter back to me that says we didn't receive such document, one, we know they're lying. Not lying. We know they're just incompetent. Most of the time, servicers are just stupid. They're not evil. They just seem evil. They're just totally incompetent. So we know that they're wrong. And because we sent it by a request for information and already followed up with a notice of error and maybe another request for information, them sending us the document, instead of looking like to a court and making a borrower feel like they're out of their mind and looking like to a court that the servicer has been reasonable, told the borrower, you're missing a document. Instead of that situation, because we've documented everything and documented servicing violations, when they send a letter that says you're missing a document that we can prove and know by RESPA notices that they're not missing, that creates a RESPA violation. That's another notice of error. And then if they deny the modification, then you send a notice of error and an appeal because they relied on the wrong information. So my point is, everything surrounds proper work under the RESPA rules. Request for information, notice of error. Every single time something is messed up, you send a notice of error. Every single time you send something substantive to the lender, to the mortgage servicer, you follow up with a notice of error. You just document everything. And I'm going to tell you this. If you feel inundated by mortgage servicers sending you paper because they're really good at sending you paper, a lawyer who understands this system can blow that servicer away as far as paper goes. It's really simple. Once you break it down, everything gets documented by RESPA notice. And so, last one, received too many loan modifications. It's the same as everything else. Some investors do have limits on loan modifications. Show me the guidelines. You don't want to show me the guidelines? Then the guidelines don't exist, and my client meets the guidelines, and this is a reasonable payment. They can afford it. Therefore, taking an appeal because you didn't demonstrate that that's actually the guideline. So I guess what I'm telling everybody is the same thing that we said when we talked about the denial letters. A denial letter is the start of an opportunity to save a house. It's not the end of a process of a modification. Now, talking something personal, my favorite sport is judo. Has nothing to do with mortgage modification. So you think. So you think. Judo's a war. This is a war. And importantly, judo is utilizing the opponent's strength against them. What you have here is you have a monolithic company that says X. But because they're stiff as a board, they're not able to move. You can take them down many times by being clever and active and smart and tricky. And what you need to do is take this monolithic, stiff monster that you're fighting with and make it uncomfortable. Make them explain themselves. They don't want to do it. Sometimes they can do it, and then you're not going to win. And sometimes they can't do it, and you're still not going to win. But you're going to put yourself in a much better place and give you an opportunity to take these guys down on a full EPOM. All right. That was a lot of information.
And I just let you go. I just let you go and go and go. But that was a very good, clean, quick summary of the amount of inaccurate, false information that borrowers find themselves in on a regular basis. They try to do a quick fix. Quick fix doesn't work. Oh, I heard this guy said this. And people don't have the actual practical experience to navigate the guidelines, number one. They don't have a good fundamental grasp, a thorough grasp on the guidelines. So they don't know exactly where to push back in the RFIs and the NOEs. So it's all about that intake, right? Going into the case, if you are able, a lot of times you don't have enough time to get all the information, but the smarter way to do this would be whenever possible, get as much information as you can from the client, do the request for information /NOE at the intake when the client gives you his full story. And again, I just wanted you to touch on the fact that whether it's in a state foreclosure case or in bankruptcy, you can still use this exact same process.
You can use the process, and I think, Bobby, you've got half of it nailed right there, which is exactly right. You have to understand how the notice of error RESPA system works. But, and this is more for attorneys than non-attorneys, you also need to understand the weakness of your opponent is its strength. Its strength is, this is how things work, this is how we do things. And you know they're going to run to court and say, Judge, this is how we do things. They didn't meet the guidelines. That's their strength. Their weakness is when you say to them, even before you get to court, listen, guys, you're telling me something, but I have a right to know whether or not you're telling me something accurately. And their live nerve is opening their hidden modification guidelines. Push on those. Push on those. They will do a lot to avoid disclosing. They'll do a lot to avoid a bad result in court. And you're going to end up with opportunities for a resolution that you may never have seen before.
So if you would please do one of your summations to our to this recording. Denials.
I'll say it again, and I've said it 1,000 times to people in my practice, to other attorneys that I've spoken to in the seminars I have done. The loan modification denial is where you have a client with a reasonable amount of income against the law, okay? if it's $1 million loan and somebody makes $50,000 a year, none of this makes any sense. But if you have a reasonable amount of income against the loan, a denial is not the end of the road. It's the start of winning the fight. Because digging into the denial, sometimes they just make mistakes. But realistically, what you're doing is you're digging into the denial to force them to show you that their denial was right. And the only way they can do that is by opening up their hidden information and giving you their modification. Anything short of that, in my opinion, should by default be rejected and be a notice of error and a request for information again as to how they made their decision. And a denial has to tell you everything you need to know to do an appeal. We've been through that in a different video. Here's a much broader approach, which is, yes, they have to tell you what you need to do an appeal, but they have to do an effective appeal, but they have to give you the information you need to know to ensure that they're right. And if they won't do it or can't do it, I think that's a rest of the suit on its own, so long as you've got a sufficient number of RFIs and NOEs in. I really do. I really do.
Okay, Josh, thank you so much.
It is my pleasure. I love this stuff.
All righty, talk to you soon.